Welcome to your weekend News Radio 600 Kogo listeners. Sully here, San Diego Business Saturday. Great to have you on the air. We're going to talk to Dan Negroni today, millennial expert. We got to get our minds off this stock market because we're going to talk to Christina Gustin of UBS, which is not necessarily a bad thing. It's just that we got some tough stuff to discuss this weekend. I'm going to give you an overview called Yield Curve 101. And I know that sounds a little dicey, but it's going to explain a couple things. You're going to feel better about the market. So here we go. San Diego Business Saturday is on the air. All right, so let's kick the thing off because a couple of things that I'll be Captain Obvious for here just for a second, and I just think let me just get this out of the way. We are in an area of volatility. I mean, the global economy has begun to shudder by all intents and purposes. And on Wednesday, the stock market tumbled after a reliable predictor of what I'm going to call a looming recession flashed for the first time since 2008. And that reliable indicator was the yield curve, and I'll explain that later. On top of that, though, two of the world's largest economies, Germany and the UK, appear to be contracting. And here's the thing about a recession. You don't know you're in a recession. You don't know you've had a recession until after it's over. How about that? Because you have to be able to see the beginning and the end, and you can't really do that unless you're out of it, right? And not to mention that Argentina's stock market fell nearly 50%. The Dow fell 800 points that day. And I was telling Ted and LaDonna this week on the San Diego Morning News here on News Radio 600 Kogo that isn't it interesting that guys like me and gals like me across the country on radio and TV are saying the Dow has dropped 800 points or the Dow's dropped 3%. What sounds worse? Obviously, 800 points sounds worse. So the following day, I remember Thursday morning back on the show, I said, the Dow has gained 25% back of what it lost yesterday. Like, that sounds great. You know, it was 60 points, right? It was like, or I don't remember. I think it was, we gained back 200 points. It was sort of a big fizz moment. But so what's driving the market this week is, look, financial markets may be shifting to a new era where fundamentals actually matter. And this should come as no surprise. During a volatile cycle, investors want to avoid more interest rate hikes. That's obvious. During an easier cycle, investors want evidence that the economy is still healthy. So the fundamentals, particularly in the U.S., are not terrible. Interest rates are low. Inflation is down. They're stable anyway. Job growth is solid. A lot of mortgage borrowers are able to refinance with lower interest rates. But word on the street is that the trend may be heading away from stocks at the moment. Here to talk about that, my good friend Christina Gustin, wealth manager at UBS Financial, RKG Wealth Management, exactly. And again, literally the person, my go-to person, if I'm going to refer you to a money manager, she's not a sponsor of my program. She's just a friend of mine, but this is the person I go to. In fact, Christina, I got a couple other clients for you because after weeks like this, they always call me. So welcome to the program.
Thank you for having me. What a week.
So how is your week going? Because your phones are ringing. My phones are. See,
I hope that you're right about investors refocusing on fundamentals, but that's certainly not what we saw this week. I think there was a lot of hysteria, and there's a reason why August is typically one of the worst months for stock of the year. And I think let's not forget that most of the trading desks have skeleton crews right now because everyone's on vacation.
Yeah, exactly right. So of course, and that does have part. I mean, that does kind of weigh into this too, is that there's less people to talk you off the edge and say, "Are you sure?" And I know the money management business is just like everybody else. Everybody's got kids. Everybody's got lives. They go on vacation in August. There's a reason we had a sell and may go away adage for so long. And I realize that hasn't been completely true over the last several years, but still, we are existing in that sort of reality of it is summertime. So you guys get reports all the time at UBS, specifically about the yield curve and about warning signs and triggers. I know you guys, look at a bigger picture than just technical analysis and such. You look at historical analysis. But for you guys, was there enough warning for you to make shift make shifts months ago, because you guys don't make shifts on the fly. You guys think about this stuff before you shift portfolios and shift risk and so on and so forth. When did all this stuff start coming down the pipe for you guys? Because I know you've heard a little about this prior to most people hitting it in the news, right?
Yeah, it's been gradually happening for a while now. There were some indicators that inverted, some parts of the yield curve that inverted earlier this year. It was, like you said earlier, the 2-year and 10-year inversion that happened this week that hasn't happened historically for a very long time. And just to give your listeners an overview of the yield curve for those that may not know and what that means, generally the shorter time period that you have your money invested in a CD or a treasury or something like that, your return will be lower than if it's longer. You need to be compensated. If you're locking your money up, committing for 30 years, generally your return would be higher for the longer time period. And as the period of time gets longer and the interest rate gets higher, if you charted that out on a graph, it would look kind of like a rainbow, and that's the yield curve in a healthy market. When you have it inverting, that means that the shorter term investment has a higher return than the longer term, and that's what's happening this week. And it's a trend that's been developing for a while, but like you said, we do have a lot of reports that come out on this stuff. They published one this week that's titled "Yield Signal Recession Risk, We Say Not So Fast," because although this yield curve has been a reliable indicator of a recession, it doesn't mean that it's starting tomorrow. Generally, there's a lag between when the inversion happens. It's about 22 months on average, and in those 22 months, the average rise in the stock market's been about 40%. So this doesn't necessarily mean dump your portfolio.
Well, the other piece of this thing also is, there is a moral of this story whereby, the key determinant that shapes the path of the economy is consumers. They offset the damage done by policies that impede world trade and such by still spending money. and I think that I mentioned earlier this week that all eyes should be laser focused on households in the coming months, because look, our economy is doing great. Now, keep in mind, I understand we've got wage stagnation. I understand that we've got some volatility here, but at the end, our job growth is unbelievable. And I think one of the mistakes people make, Christina, is that people mistake the stock market for the economy. And although they're joined at the gut, it's typically different than that. And I think, where you look at this, we've been top heavy for a long time here. We've had essentially, since the big pullback that we saw, or what we call the Great Recession, we haven't really had any down, into a full-blown bear market. We've had some sideways years. So, this is sort of healthy for us, right? I'm not necessarily saying buy the dip, but I think it's sort of healthy to have a pullback and a sideways for some time to consolidate, don't you?
Yeah, certainly when things are overvalued, a little correction can be healthy. UBS is only seeing a 25% chance of recession, full-blown U.S. recession next year in 2020. So I don't think that we see a huge probability of a major slowdown right now. All the headlines are screaming about global growth slowing down, and that trend also has been developing for a while. But again, there's a difference between deceleration and a screeching halt. And deceleration, there's no doubt that's happening, but things still are not that bad.
Well, and when you talk about that, your phones are ringing this week, and I think the other thing people have to look at is their time horizon, right? I think that at this point in the trajectory of the market, if you're 85 years old and you're depending on everything you've saved over the years and you're living off returns that are probably pretty conservative, that's one thing. If you're 55 years old and you're probably 10, 18 years away from really, truly retirement, you're not going to take your money out and sit it on the kitchen when it's done. It's still going to be working for you. I think some of those that's some of the context people have to start realizing is you don't take your money out today. I was just explaining to somebody today at KUSI, because I did a quick hit over there, and he said, how can a company show negative earnings and this and that and still be in business? And how can Germany, have a negative bond? I said, it's just a snapshot in time. It just gives us a clipture of this moment in time. Life hasn't stopped, so on and so forth. Do you address it? I'm assuming sort of the same way, because your job is to talk people off the cliff. Let's face it.
So I've been telling people to turn off their televisions all week, and like you said, you expand out on that chart. If you zoom in on any day or week in the markets or a particular investment, certainly this week has been scary for people. An 800-point drop is a big deal, but when you zoom out on that chart and look at years and decades, over time we still believe in this way of growing personal wealth. And when you tie it to a financial plan where you know exactly what is the objective of this portfolio and what is the time horizon, it really calms people down because they understand this is a long-term game.
Yeah, it is. And I think that's the one thing we have to look at. The stock market always is your friend. It returns to the mean. Just look at the last 10 years. Don't you wish you would have got in to Apple in 2008 or 2009? Now, I know you didn't think about it then, but there's several stocks that you would have done better with by leaving your money at risk versus taking your money out of the market. Christina, thank you so much again, one more time, as she's our regular sort of pontificator and calmer downer of investors, which I think is on her business card. Christina Gustin, RKG Wealth Management, UBS Financial, my trusted financial advisor. And I'll tell you, she's not a sponsor of this program, which I think adds a little bit of an agenda here. All right, let me break down this yield curve. I'm going to tell you exactly what really is the problem here. And it's going to make you feel better. You're going to feel much better after I tell you in a couple of seconds what's going on. Also, coming up in the program a little bit, Dan Negroni from Launchbox 365. It's San Diego Business Saturday. I'm Sully, News Radio 600 KOGO. Hey, it's News Radio 600 KOGO, and I'm Sully. It is San Diego Business Saturday. Welcome to the program. I want to remind you that a couple of things. You can find me here every morning on the San Diego Morning News with Ted and LaDonna. Also over at Good Morning San Diego on KUSI. And the Big Biz Show, our national television show weekdays. We're also on 150 radio stations right here on iHeartRadio. With myself and Rusty Nails, bigbizshow.com. Also, there's a TV version of San Diego Business Saturday. And you can watch it right after the program, 10 o'clock today. It'll be up at the website, kogo.com, keyword Sully. Mean producer Lady Mary will have it up there at that point. Okay, let's talk a little bit about what's going on with this thing you heard about called the yield curve, because I think there's I know your eyes should glass over when you hear things like that, honestly, because it's sort of a nuanced technical indicator in the stock market. So let's talk about what a yield curve is. It's a way to measure a bond investor's feelings about risk. In general, just as Christina was saying, short-term bonds carry lower interest rates because your money's in for a shorter amount of time, hence a short-term bond, right? Short term. So it's going to reflect the fact that that the investor's money is in for a shorter time, therefore there's less risk because you're not in as long. The thinking behind getting paid more on the long-term bond is that you're committing your funds for that term, and you're getting rewarded for that commitment. Make sense? Short term, less risk, less reward. Long term, longer commitment, more reward. It means that the government is going to pay you less on a short-term bond unless the curve moves. Now remember, interest rates fluctuate, right? Well, when the government tells you, hey, look, I'm not going to pay you as much in the long term. In fact, I'm going to pay you more for the short term. Well, that will tell you that the government needs money, right? Because aren't you willing to pay more interest when you're in a panic? That's what's happening, right? Or so it seems. So for the first time since the run-up to the Great Recession, the returns on short-term U.S. bonds were higher than long-term bonds. And what that means is that governments in other countries and sort of pontificators start getting worried. Normally, as I just said, the government needs to pay out higher rates to attract investors for long terms. But with so many losing confidence in the near-term prospects of the economy, now let me say that again. People are losing confidence in the near term, right? Could anyone argue that it isn't completely volatile right now? Could anyone argue that when Donald Trump tweets something about the U.S.-China trade war, that people are on pins and needles because the market reacts? Honestly, it's like turning a dial. And again, so many people sort of confuse the stock market with the economy that happens. So with so many people losing confidence in the near-term prospects of the economy and rushing to buy long-term bonds, the U.S. now is paying more to attract buyers into the 2-year bond. Okay? And the phenomenon suggests that the faith in the economy is faltering, and it has preceded every recession in the past 50 years. So do you see why when this signal flashes, everybody turns tail? Because that's what's going on. They're turning tail. But there's a problem. Now, let's talk about a bond for a minute, okay? I think there's some confusion on what a bond is. A bond is nothing more than a piece of debt, all right? It's just a piece of debt. In other words, when you buy a stocks and bonds, you're buying a piece of equity. You're buying a piece of ownership in a company. Well, when you buy a bond, you're buying a piece of ownership in the debt. All right, so let's break this down. Typically speaking, municipalities, for example, okay, governments, local cities, they can't go to a bank to build a freeway. Bank doesn't have enough money to build a freeway, right? So they float a bond. They say, we're going to raise $50 million to go build this infrastructure. And you're thinking, and by the way, we're going to pay back this much money on it, and it's backed by the full confidence of this city or this government. You think, well, it's the city and the government. We wouldn't be building things like freeway if we weren't healthy. So I think I will put my money and invest in this bond. In other words, you're going to take a micro piece of this debt that the city or municipality is essentially borrowing from you, and en masse borrowing from a bunch of people until they have fully subscribed bonds. And then when the time comes up, okay, they build their freeway, things go wonderful, and they start paying back the investors, right? And that's how a bond works. So I think this is a piece of what we have to understand is, what is a bond here? Why this bond market affects the stock market. And I think the big piece of this thing is because if you think in terms of bonds being attached at the hip to interest rate, okay, that's why when you see interest rates increase and decrease, it affects the stock markets so drastically. And there's really sort of 7 types of bonds. There's treasury bonds, and there's government bonds, and there's investment-grade corporate bonds. There's foreign bonds. There's mortgage-backed bonds. There's municipal bonds. And which one you want sort of depends on your tax bracket. It depends on your investment objective. And like, for example, some people like investment-grade corporates are issued by companies that are financing something that they're trying to do. They don't want to sell their stock. They don't want to dilute what they're doing. So they float a bond in order to, Apple wants to build another gadget. I'm not saying Apple's put out a bond before, but just there's an example. But what we're talking about here with this inverted yield curve is municipal bonds. We're talking about government bonds. We're talking about treasury bonds, to be specific. So this is not the stock market. This is the debt market, right? Stock market, bond market. The debt market has been tampered with, and it's been tampered with by governments who do one thing. Do you remember the word quantitative easing? Okay? The using of one's own currency to purchase one's own securities? Well, that means governments are buying their own debt. And what does that do? That stimulates the economy. Massive debt purchases by central banks since 2008. You've heard it here. You heard Ben Bernanke talk about more quantitative easing. You heard me say every country does it. We're just the least dirty shirt in the hamper. okay? We have this hugely distorted government debt market because we've been doing quantitative easing at a rate we've never seen before. It's not bad. Every country does it. But it tilts the scale on the treasury yields. It tilts the scale higher than they should be. And the argument that a high interest rate is going to trigger an economic downturn just doesn't float anymore because things are not the same. It hasn't completely screwed the markets up, but you can't depend on these indicators that you could as accurately as before. So I think, your moral of the story has to be stop obsessing over the yield curve and its power to predict a recession. Yes, I realize it has been a yield curve whereby short-term eclipses long-term yields have preceded every recession. I get it. Okay, it's bulletproof. We haven't seen, though, this sort of tampering with debt markets before. So I don't think it has the same power to predict a recession. Neither did Christina Gustin, neither did smart people at UBS. Listen, I can tell you, go across the board. There's very few people that think that this is a foregone conclusion. Did the markets get spooked? Hell yes, they got spooked. They're going to get spooked. The key determinant that is going to shape the path of the economy this time is not going to be the yield curve or the direction of the Fed funds rate. It's the extent to which you and I, which American consumers, will offset the damage done by policies that impede world trade, that reverse globalization. And do you know how they do that? We spend money. We spend money. We all need to be laser focused, and I mean laser focused, on what households are thinking and doing in the coming months, and not on some, and yes, I'm going to use the word, tampered yield curve. All right? And I think the last piece is, I was telling Paul Rudy this week over on KUSI, Good Morning San Diego, I can't remember what day it was, might have been Thursday. There's a political side to this thing. And I was asked the question, isn't there one side that sort of wants a recession because they want the economy to tank? Well, sure, there's always, it's like when Rush Limbaugh said, I hope he fails. He was talking to President Obama. What he was talking about is, I hope he fails because if he succeeds in his plan, it's going to be exactly the opposite of what Rush Limbaugh wanted to see with this country. It's sort of the same thing with one side of the political spectrum, does not want to see a great economy going into 2020 because it would probably usher in a re-election of the existing administration. So I would say, yeah, there's probably that. But the other thing, too, is our stock market is basically a daily report card for the president. And it shouldn't be, but it is. It is a daily report card for this president because so many people sort of confuse the stock market with the economy. And I've told you this 150 times. I think I tell it to you almost every week. Although the stock market and the economy is joined at the hip, okay? Although it's joined at the hip, it's not the same thing. Stock market's a leading indicator on how things are doing, but if you look at the amount of people that actually participate in the stock market, we're only talking a fraction of Americans, less than 50%, okay? Feel better? Because if you don't feel better, you're completely confused, I know I'll get emails. Which you can email me either through the bigbizshow.com website or the kogo.com website, keyword Sully. All right, in 6 years, 75% of our employees, 75% of our consumers are going to be the M word, millennial. Dan Negroni, expert on millennials. He's been on the program before. He joins me again here. San Diego Business Saturday, News Radio 600 Kogo.
What do you think the teacher's going to...
News Radio 600 Kogo, San Diego Business Saturday. I'm Sully, your host. Good to have you along today. All right. Dan Negroni is coming up next with me in just a second. I do want to talk a little bit about our website, kogo.com, keyword Sully. You could listen to the show there. You can actually watch the video of the interviews that I do here on San Diego Business Saturday. There at kogo.com, keyword Sully. Also check us out at bigbizshow.com. And then you can find me here on Wednesdays with Ted and LaDonna. At 8:10 on Wednesdays, talking all things business as well as KUSI. Economic calendar I'll talk about in the next break, and we'll talk about some San Diego stocks. Millennials are coming to the workplace, as we just mentioned. We better be ready. I mentioned about jobs, transportation, and housing preferences, and before I get to Dan, millennials are migrating to cities and driving the success of the shared economy, this thing that we call the gig economy. And this generation is moving to cities after college, and they're staying there indefinitely. That's helping cities like San Diego. For the first time since 1920, our city, as all cities are, growing faster than everywhere else in the world combined. Millennials using public transportation, 40% more, and cars 23% less. Plus, they're twice as likely to participate in the sharing economy, from ride sharing to apartment rentals. So this is the technology era, and this is why it's so interesting right now to take a look at the NASDAQ. Now, the NASDAQ, the Dow, and the S&P all having great weeks, all having a great 2 months ever since Christmas Eve. We've gained back everything that we lost, as I mentioned earlier today, all through December. But the NASDAQ, the tech-heavy NASDAQ, to cross over 7,000, to cross over 7,500, to be staring down the barrel of 8,000, that has a lot to do with millennials. From home to health to personal services, millennials are adopting this new technology, and they're spending money and they're investing money with the companies that meet their increasingly high standards. And they do have high standards and for new and innovative technology. It's a big cycle here. Do you realize that in the next 7 years, 75% of our customers and 75% of our workforce are going to be millennials? More than half of millennials plan to buy connected Internet of Things. So you got to take a very close look at the NASDAQ. I want you to take a close look at the NASDAQ chart, and you'll be able to see very quickly where they're coming in and maybe where you should take a look at it. Don't want to get geeky here, but we got to take a look at that NASDAQ chart, and we've got to look at it closely. And I'll be spending some time with that with you guys coming forward. But let's take a break from that, because we've been talking a little bit about some facts and figures on millennials, and if you don't think our world is a changing, you need to think differently, because Dan Negroni, San Diego CEO of the company Launchbox 365, author of the book Chasing Relevance, best-selling author, Inc. Magazine top 100 leadership speaker. He's an attorney, an entrepreneur. He is the parent of millennials. He's a coach, and he's here to tell us and unveil the mystery behind what we're calling millennials.
You know, I thought you were doing a good job. Those stats were just rolling off your tongue. I thought I got some competition here.
Well, I'll tell you, most of it I got off your website, by the way.
Oh, well,
in fact, everything
I was
got
like, how does he know all that?
Well, first of all, your website has a lot of great stuff on it. But then I started researching the business side of things and talking about how income is clustered and so on and so forth. But if you go to launchbox365.com, and it's so funny because I've used your website this week a ton, because I've been on the air in a number of places to talk about your topic. And of course, as I'm walking out the door, I said, hey, next time just get Dan Negroni in here because he can tell you. But if you look at some of these figures on your front page, and you talk about how millennials are the new power, and you talk about 36% of today's workforce and 75% of your employees in the next 6 years and $660 billion in spending, give us a perspective on that, because I think this snuck up on most of us, didn't it?
I think it's been over talked about, to be quite honest. No one's really solving the problem.
Right.
And we get in there and we coach and we bring people together and we give millennials the voice they should have of maturity and demonstrate how fantastic they are. But there's been a negative slight to millennials for quite some time.
Well, you're talking about stereotypes, correct?
Right.
You're talking about and let me just list them.
Yeah.
Most of us think millennials feel like they're entitled. They don't have a good work ethic. They
lack loyalty.
They lack loyalty. They want to go to work where there's a pole that they can slide down from the second to the first floor into the kitchen, where they can eat Cocoa Puffs, and then take a quick nap before they go back and not work.
And they want to go from the mailroom to the boardroom in about a day and a half.
So and what you have found is almost none of that is true.
Bull.
Really?
Yeah.
Talk about it. Talk about
Yeah,
talk about what you found. From
first of all,
working with them.
millennial are people too. Believe it
Okay.
or not, we're all people. We all suffer from the same ilks, and we want the same things, which is to be better and to make a difference. Actually, they're even better than us as that. You have the statistic. They want to really care about purpose and contribution and do things differently. They've grown up with technology, digital natives, and so the world is completely open to them and smaller, and they want to make impact, and they believe they can, and they can.
So when you've coached how many millennials so far since the?
I don't know, it's like 14 or 18,000, like a ton.
Now, and when they come in the door, and you have a lab there at Launchbox 365, where basically you're doing a number of things with them. You're taking them through sometimes traditional corporate training, sometimes you're doing one-on-one coaching, so on and so forth. But when you as a person and as a company eat, breathe, and sleep millennial, when they're first walking in the door, is there a typical arc of that story that they're trying to get to?
So when they're first walking in the door of the lab, they're sold. So it's a little bit different.
Because they want to change.
They want to change, or their company has sent them to change and they're open, or they're a little bit nervous, but they're ready to expect something different because everyone has told them about it.
Right.
The difference is, like this morning, I had a call from someone who was trying to sell me custom suits.
Okay.
And it was a millennial, and she was very sweet, but you,
wait. So
you know
had-
the drill.
You had a phone call.
I get a sales call. Oh my God, right? Dan gets a sales call. And really my point to you is that I'm coaching this 24/7 all the time.
Right.
And this person calls me and basically says, I dress people, and
You don't want to buy a suit, do you?
Yeah.
Or something like that.
so-and-so referred me to you.
Right.
And basically it was the worst pitch I've heard at least all day, but probably all year.
So-
And the year is young, but you know.
So what did you do? Did you just hang up the phone and say no, or did you?
No, you know me. So I said, look, first question a coach asks is, do I have permission to coach you?
Okay.
And so, hello, I had permission to coach. Kind of begrudgingly, yes.
Okay.
And then she really didn't know what was ready to come, but it was like, wow, do you need some help with framing a question? How about if it looked like this, this, and this? How about if, you said these different things? How about if you asked me some questions? Did you look at my website? Did you see how I dress? Do you know what we're doing in speaking and how we want to communicate our brand and our value? Did you look at dannegroni.com? Did you look at Launchbox? Did you see we wrote a book? Did you look at all the video clips out there? And the answer was no.
Sure.
And so it's like, do your friggin' homework, right?
Right.
Do you,
But that would seem to me like almost any. Well, I shouldn't say any. That
Any
can't be. That
age,
can't
yes.
be nascent to millennials. though.
No. I had a call yesterday from a broker from Morgan Stanley. Same thing.
Okay.
Well, actually, it was a little bit.
So
better.
how was he or she? I think you said she. Was she open to the coaching, and did she decide that she wanted to?
What she wanted to do was defend her position. And so, tip for millennials out there: if you want to go further in your life and in your career, be persuadable. Right. The most important thing of a leader: vulnerability. Number 2 is probably be persuadable.
With your background as an attorney, as an entrepreneur, and now a millennial coach, let's take the corporate side of things. Are corporations here in San Diego ready for the onslaught? Because look at in 6 years, even
Yeah,
for your
4
own
years,
research, 75% of our customers and our employees are going to be millennials. Are we ready as a city here?
I don't think we're ready. I don't think anyone is ready enough, quite frankly, and that's because, if I asked you the question, what percentage of people do you think are self-aware? And so it requires the same thing. What do you think is the percent? I've read a Harvard Business Review study.
Are self-aware?
Yeah, self-aware about what the challenges they face or what the future is going to bring them, or want to change.
I
or do
would
something different.
I would have to answer that. It depends who you talk to. I'm overtly self-aware, but I would say most people probably are
Most
not.
people we know, right? You surround yourself, you attract what you want. I would say it's like, I think the study showed 5 to 10% are self-aware. So I'd say the same thing
So
about
corporations are not self-aware.
Yeah, they're not aware about what the future is going to bring them.
Dan Negroni is our guest today. Dan Negroni, of course, dannegroni.com. He's a keynote speaker. He's a best-selling author, a master coach and trainer. His company, Launchbox 365, right here in San Diego. You train your millennials and their managers to create results, is what your website says. Talk about the corporate side of things. When you walk in the door, and I know you train a lot of corporations, and you have, of course, all this experience with millennials. What are the takeaways that they can expect from sitting down with you? And are their eyebrows raised immediately? Or are they pretty open to the
I think
idea?
it's about it's like every consultant approaches the project. Are we going to help you get ROI?
Sure.
ROI on your investment to train people. And what are you looking for in ROI? You were talking about the Dow Jones and numbers and stuff. Are we going to make money? Are we going to save money? Are we going to reduce risk? Or are we going to create innovation to create a new product? Right. Those are the 4 things. And so we look at what are the things that make that up, and engagement and employee engagement is really critical to that, and how you take care of your customers. And so you'll look at what type of engagement do you want? What type of culture do you want? And we ask really important assessment questions, and then we get in there and we start coaching.
Are corporations paying attention? Like when you start talking to corporations, and I'm just only because we were talking about their stock earlier, I'm going to say Illumina. Would you be surprised if you walked into a corporate training environment at Illumina and they were not already aware of it? In other words, a company like that, you're talking about a Fortune 500 company, you're talking about a company that's on the NASDAQ. That's
for sure they're aware of it. I've actually spoken to them, and so they're clearly aware about it because they have turnover and they have retention rates, and they're hiring these young people out of school, and they think that they are different, and they are different. I mean, they're still human beings, but they approach life differently because of technology.
There's certain universal rules, and from talking to Dan and interviewing him prior, I know that there's universal rules that can be applied to big business as well as small business. We're going to delve into that a little bit. Also, what do they do differently is a big piece that we have to talk about. We're talking about millennials. They are the new power. We're talking with Dan Negroni, Inc. magazine, top 100 leadership speaker and author of the book, Chasing Relevance. And of course, you can go to his website, dannegroni.com. We'll get to all that and more and answer all of your questions on what it's like to be able to hire a millennial or be a millennial going to the corporate world. But first, let's check into traffic. News Radio 600 Kogo. It is San Diego Business Saturday. I'm Sully, News Radio 600 Kogo. Wow, lots of stuff today. Dan Negroni filling our heads with all things millennial, and I'm glad about it because they're changing everything we do, including how we're investing. By the way, coming up next week, Ernie Hahn, the CEO of the Sports Arena, is going to be with us. We're going to talk to him about how the sports arena is affecting us San Diego economy and us as San Diegans. Talk about the sort of the inside scoop on how sponsorships work there and how concerts are done there and events are done there and why it's so important for San Diego economy. Ernie Hahn joins us next weekend on San Diego Business Saturday. Back to Dan Negroni in just a minute, but I want to talk about the economic calendar for next week. Lots of things happening next week, beginning with housing starts, and that's really a great open-air indicator on how the economy is doing. We're going to hear about housing starts on Tuesday morning, which also gives us building permits and the Case-Shiller Home Price Index. We all want to pay attention to that because that tells us how our real estate market is doing, also along with new home sales. Same day on Tuesday, we've got Consumer Confidence Index in just a couple of days coming up here. One thing I always love to look at when we're talking about home sales is not just the new home sales, but it's the pending home sales, because it sort of tells you the disparity between what's in the pipe and what really is going to close. It sort of gives you a real idea of where the market's trending with respect to real estate. Jobless claims come in on Thursday. We're going to hear about the GDP, the Q4 GDP. This is a very big number for people to take a look at, because remember, we were crashing with the stock market. And what this administration said the whole time is, look, at the stock market might be crashing, but the economy is still good. The jobs are still good. So let's see what happens. We're going to see that this coming Thursday. The GDP comes out. And then, of course, on Friday, we're going to hear about personal income, consumer spending, core inflation. Very big week for news, maybe one of the busiest news weeks we've had so far this year. And we're going to take a very close look at that to sort of predict and see what goes on with the markets coming up. Taking a look at a couple of stocks in San Diego, Cubic trending higher, still below a 50-day moving average, but trading above a 15-day moving average, trading just over $60 a share. Probably time to take a look at that. I think the other one to take a look at is Illumina, stock symbol ILMN. Illumina's been so range bound, but they're right around the 305 range right now. Seems to be trending up. I wouldn't put this on a buy signal yet, but I would definitely say it's definitely a hold. Our ever favorite Qualcomm. Qualcomm is now going sideways after we talked about the Federal Trade Commission last week. It's probably something that we should probably stay away from for right now. I'm not going to necessarily say that we don't like Qualcomm as an investment long term, but I think it's probably something that we want to stay away from for right now. Let's talk some more about millennials. But Danny, I have to ask you, when you think in terms of millennials, and we were kidding about it a little bit with respect to the kitchen and the lounge chair and the nap room and all that stuff. Yeah. What are the things that millennials really want to see out of the workplace? Because I think there's I think there's this misnomer that it's all about summer camp, but it really isn't, is it?
It's not all about Uber and free dry cleaning
stuff.
and free food. No,
Okay.
no. The number. I mean, we've done some research on it, and we find in every organization, whether I'm working in Singapore, Saudi Arabia, wherever I am working, or here in the great old U.S. of A, there are 4 things that millennials want in the workplace. You know what number one is?
Wait a second, though. When you say working worldwide, are they the same whether you're in Saudi Arabia or you're in Qatar or you're in France or you're in the U.S.?
I would say this. My experience has been that in places that are like the U.S., like Singapore,
Okay.
which has a very English-speaking bias and culture.
Sure.
Yes, exactly.
Okay, so
if
what's
you
the
look at South America, China, a little bit different.
Okay,
culturally.
because cultural differences, right?
yeah.
All right. So what's the first one?
What do you think is the first one?
Millennials want in the workplace?
Yeah.
Direction.
Direction. And I think that's I think this is a microcosm of direction. The number one thing millennials want in the workplace is to learn and grow.
Okay.
They want mad skills so they can be better at any job they have, and they can make a difference and create contribution in the world. And so they want to learn and grow. So they want great mentors that they can respect and trust and are going to teach them dope stuff.
What do you say to those people who say, well, they're not going to listen anywhere, they're just 20-year-olds?
That's a crack.
Is it really?
Well, I'd say you're a very poor instructor if they're not going to listen to you.
All right.
Right?
What's
all
that?
about who's delivering the message. If you demonstrate to people appreciation and you care about them, they will always want to help you and do something.
Then what do you say to those people who say, well, appreciation, this is a workplace. Why do I have to baby them? I would argue, well, listen, if that's what they expect and they're going to represent 75% of everybody in 5 years, you better kowtow a little bit, right?
I mean, like I have those hecklers in the audience wherever I speak. I get a heckler. I don't give a hoot. These guys can do whatever they want to do. I'm going to do my thing. And when I was younger, I didn't have to do that. I walked 2 miles to the snow barefoot.
The get off my lawn approach.
Right, get off my lawn, which is, it's a bunch of nonsense. And the truth is, you want your business to have ROI. You want to do better things. You want to attract great employees and keep them there, then you got to do this stuff, like it or not.
What are a few more of the things that millennials want out of the workplace?
So number 1 is learn and grow. Number 2 is they want authenticity and transparency.
So that's what we were talking about earlier. When they've got a good BS detector. They've got a very good detector, as we talked about earlier in the program, for sniffing out disingenuous ideas.
And even if they don't, they think they do. Because, information is available to them, and so they confuse information sometimes with experience.
The University of Google.
Right. Our job is to teach them how to apply experience to information. Okay. So number 3 is feedback and communication. Some people say they want too much. My wife may want more than I want to give her too.
Right.
Actually, not in her case, but nonetheless.
Sure.
And then the 4th thing they want is purpose and contribution, and they want to be valued.
Now, purpose and contribution. This goes on with what I was talking about earlier. Millennials are a values-driven generation attracted to brands that stand for something. Is that sort of what you're talking about there?
Absolutely.
Right.
And it's no secret that the top 100 companies millennials want to work for are the top 100 millennial brands. Nike.
I mean, so.
If you stand for something different.
So now we know what the millennials want. So let's move over to the corporate side.
Yeah.
What are the actual items that businesses here in San Diego can start thinking about when they start hiring this workforce and we start seeing our economy change as a result?
Let's clarify something, which is a question that people ask me, Dan. Is that so different what they want than what anyone wants in the workplace? And the answer is hell no.
No, I was going to say it sounds pretty familiar.
Exactly.
Right?
It's pretty familiar. People want to be engaged. They want to be cared about. They want to learn and grow. They want people they can trust. They want feedback and communication, and they want to stand for something and give something and feel like their life has value, period.
Yeah, I agree.
Same things.
Yeah, I agree.
So the question is, what do corporations?
Yeah, what are the actual tools that you can give corporations that they need to be thinking about?
Let's talk about stuff we're going to do. When we give our big keynotes, we talk about what are the 5 areas you're going to... First, if millennials are going to be 75% of the workforce, Gen Z's right behind them, we got to attract them.
Yeah.
So we got to attract them to our brand as customers, and we got to stand for something.
Okay.
And we got to stand for them in their language.
Sure.
So we got to use Instagram, we got to use LinkedIn, we got to use the website. We got to have an employer.
You better be talking their language, is what you're saying.
And you have to have an employer brand. The brand of the type of employer you will be for the world. We're going to do a webinar on that in late January or early February. There is a specific thing you want to say to your prospective employees and want to be known for.
Folks can go to Launchbox 365 and sign up for that and get involved in that. What else? So attracting them and then, of course, hiring them would be
so
next,
attracting them's number 1, and better have so they can do it online and all those things. They want to dive in online, learn about you, and then they want the follow-up in person. In terms of hiring, all the time I say to employees is, why are, it's not that millennials stink, it's that you're hiring the wrong millennials.
Well, sure.
Why do you stink so bad at hiring?
Yeah, I think that's a big piece of this too, is that you have to think in terms of, look, just because they're millennials, don't make them impressive in and of themselves. They're still people, and you're going to have categories of the educated versus the uneducated,
Absolutely.
the lazy versus the motivated, and so on and so forth.
And so if you understand your employer brand and your culture, how are you asking the right questions during the hiring process to make sure that you're getting the right people that are going to work on the specific team that you're hiring for or do the specific role and tasks? And how good are you at doing that?
I'm looking at your cheat sheet here, and this next actionable item that companies need to be thinking about, perhaps is probably the most daunting, and that's training them.
Yeah, I mean, so look, I'm going to use a technical term here. Most managers suck at training people, right?
I would argue that's right.
Where most people are not very good at communication, and it takes a lot of work and micro-learning and practice to be able to communicate with people so you're not offending them.
Sure. Yeah.
Believe me, I know.
Well,
you know.
Right. And this is not about the snowflake offending that we all hear about. This is just about basic, you want to engage during the training, right? I think
so let's give them the one biggest rule about training, which is the platinum rule. Do you know what the platinum rule is?
What is the platinum rule?
The golden rule, you know what it is,
treat
right?
Others
Judeo-Christian.
Treat others as how you'd like to be treated.
Yeah, and so bull, because not everyone wants to be treated like Dan and Sully, which is straight up in your face, so on and so forth.
I would agree with that.
So the platinum rule is figure out how to treat your audience the way they want to be treated. And when you're training them, you better understand what your millennial is looking for from you when you're training.
Now, once again, you have the guys shaking their heads saying, well, why do I have to, it sounds like I'm babying these people. And when I was, I was lucky to have a job. I mean, you've heard all of these platitudes
I will
before.
tell you this. Being a parent, really, really hard. You gotta double down. Being a boss, really, really hard. If you're exhausted from being a parent and you don't want to apply those things to the workplace, it is just important. And my advice to you is, too bad, get a grip or hire someone else to perform that function.
Because they're coming and you better be ready for them.
Your employees are the most important person. They are the ones who contact your customers.
We only have just a little bit of time left here, but the last two are engage and retain. The engage, I think, is more obvious.
Engage is accumulation of all the other things we're talking about.
And retaining them, though, that's the part that I would
retaining them is really getting in when they're having an issue and making sure that you know where they are and being able to coach them. It's about coaching. Dan, it was fantastic having you today. Dan Negroni, San Diego CEO, Launchbox 365. You can go to launchbox365.com or dannegroni.com. Of course, if you're interested in having him come to speak at your organization, you can contact him right there. His book, Chasing Relevance, available at barnesandnoble.com, amazon.com, all major booksellers. All right, that does it for us. Chris Janicus, our director. Curtis Mattis, our assistant director. For Cliff Albert, me and producer Lady Mary, Jack Cronin, Marilyn Heyer, the rest of the Kogo Newsroom. It's Sully. Next week, remember, Ernie Hahn. You can get a hold of me at Jump TV, producer at jumptvstudios.com or at Sully Speaks. Till next week, News Radio 600 Kogo.